Well, so Mark, I guess if you want to just start off with, can you define what an option is and like the basic options that you can buy, calls and puts?
Sure. We can spend the whole hour just doing that if you like. But yeah, no, the very basic, very textbook definition of an option, it's kind of right there in the name, option, right? It's choice. So you have the right, but not the obligation. You're not obliged to. So the right, but not the obligation to buy or sell some underlying security at, or it could be a future, whatever the underlying is, at a particular price by a designated date. That's it. It sounds confusing, but in reality, it's a lot more straightforward. You essentially, if you buy an option, let's say there comes in two flavors, as you mentioned, calls and puts. Calls give you the right to buy a particular underlying at that particular price by that set expiration date, and the puts give you the right to sell said underlying by said expiration date at said price. So let's walk through a quick example. Let's say you're looking at everyone's favorite stock, right? XYZ. Everyone's made and lost fortunes in XYZ over the years. And you say, it's XYZ's trading at $15 right now, let's say. And you say, you know what? I'm thinking it might have a chance to run. I'm going to buy, let's say, a call at the 20 strike. So let's say in this case, the 20 strike would be the price at which you are saying, if it starts running through there, I want to buy that stock. I think it's on a nice upward trajectory. And then maybe in our example, you pay 25 cents for that. And now let's say that call lasts for 3 months. So that means anytime in the lifespan of that option, you could exercise it and buy the stock for $20. Now, obviously, if it's trading in the marketplace below $20 for the entirety of the lifespan of that option, you're not going to want to do that because you could buy it cheaper in the market. If a stock's trading, if XYZ is trading 15, 16, 17, all the way up until the option expires, you're much better off just buying the stock where it's trading. But if it gets to, let's say, 25, now all of a sudden your option, your right to buy that stock at 20, that has some value. In the case of that example, if it gets to 25, that has $5 worth of value. You could buy it at $5 below where it's trading right now and immediately sell in the marketplace for a $5 profit. So that's what you're paying for when you're buying an option. And usually people start with calls because they're easier for people to wrap their heads around, quite frankly. It's more, people usually come to options from the world of stocks. So they're used to buying a stock and they want it to go up. That's a very straightforward, most people have long biased the market. So they come to options with that perspective. So a call makes a lot of sense for them because a call option makes money as the market goes up and it loses value as the underlying goes down. So that's very intuitive for them. Puts become a little bit more involved for people. They have to buy something and say, wait a minute, I want to buy something that gives me the right to sell something in the future. That's a little bit counterintuitive at first. When you start thinking about it, it becomes more analogous to maybe when you might want to buy insurance on your house or something like that. It kind of locks in a set value for a particular underlying. So in that example we were talking about before with XYZ, let's say it's hanging around 15 again, and maybe you own some XYZ and you're a little bit nervous about some downside. And you say, you know what, if this thing gets to $10, I might want to think about protecting myself and cutting my losses because the structure of this stock, my outlook on this stock has changed. Something has fundamentally changed with this stock. I don't really want to be there anymore. So you can do a couple of things. You can work a stop, limit order in the underlying stock that will stop you out. But everyone who has experience with limit orders knows if the market gaps down, you're not going to get filled where you want. You're going to get filled wherever the underlying opens. And it could be, you can end up dumping your stock at $7 or $6 if there's an aggressive crash, something crazy like that. Whereas that put option, the nice thing about puts, the nice thing about options in general, people always debate in the modern markets, Bitcoin or all these other assets, which ones are inversely correlated to stocks and which ones are the best assets to diversify for your portfolio. At the end of the day, the only contractually obligated, guaranteed, inherent 100% inverse correlation is a put option. If you buy that put option on $10 at XYZ, let's say you spend 25 cents again in our example, and it goes out 3 months. For the lifetime of that option, no matter what happens to the underlying, if it goes all the way to zero, you still have that option. You can exercise it and sell that stock at $10. And so that's a nice thing. And so people sometimes get hung up. Puts are a little bit expensive. That's why people sometimes think about selling them. And that's a conversation we could have a little bit later. That gets very mind-blowing to new options traders. The idea of selling to someone else the right to sell back to you at a stock, whoa, that's mind-blowing. So we won't go there yet. But in general, think of puts in that sense. The call gives you the right to buy an underlying stock, and it usually goes up in value as the underlying appreciates, and a put gives you the right to sell a particular underlying, and it usually goes up in value as the underlying falls. So those are your two basic definitions of options. I hope I squeezed it in enough. Like I said, we could spend hours just debating and discussing that topic.
Absolutely. So Mark, you mentioned that most people start out by buying calls. Is that actually how you would suggest people start using options, or what would you suggest?
No, I don't. And we saw it over this past year or two, right? With the whole meme stock explosion. It seemed like everyone and their mother and their grandmother and their sister's brother were all coming into the options markets. I mean, in fact, we've seen record levels of options volume that when I first got into this business, back in '97, which ironically is when the book that we're going to talk about today was published. The volumes we're talking about today would have seemed completely impossible. I was a crazy person, pushing 10 billion contracts in a year. That's just crazy talk. So, but we saw a lot of that come in over the last couple of years as people were stuck home. They couldn't do anything else. Trading became the hot thing, and people started gravitating towards options. We saw all these various movements, the Wall Street bets and all these Reddit kids and the one lots, Robin Hoods, all these things just drove a lot of people toward the options market. In fact, I just got off a panel, my first in-person panel in 2 years. So things are starting to get back to normal just this past week here in Chicago. And we were discussing all that stuff, just what an insane year 2021 was from an options volume perspective, and how everyone was just buying calls. And that, for me, people ask me this all the time on the network, what is my number one starter? Where do I think people should start when they're trading options? And I don't recommend buying calls, because for the reason I laid out before, people are usually coming to options having traded a stock or two. They usually don't dive straight into options. That's very rare. Usually they bought a stock or they bought a couple of stocks, they've traded them, and then they graduate into options. That's usually how the progression works. So if you follow that trajectory, you're used to doing things like buying and selling stocks and working limit orders to buy and sell said stocks. So that's usually a pretty basic knowledge set and functionality people understand when they come to options. So I tend to like to build on that with their first options trade. So for me, I recommend, for a lot of people, because it's a very easy trade to wrap their heads around, I recommend actually selling options, selling a covered call in this case. So in that example, we go back to our old friend XYZ, right? Everybody making and losing fortunes for days, for years in XYZ. And in this case, let's say XYZ, once again, let's say it's trading a little bit higher. Let's say it's trading 1750. And you say, you know what? If this thing gets to 20 bucks, I don't mind selling it. I'm out there. So that's the first step in this analysis. You have to do the homework and say, you know what? Where am I comfortable selling this particular stock that I own? Once you've done that analysis, now you can go to the options market and say, well, okay, let's start looking at some prices for options. So let's say in our XYZ example, the stock's trading around $17.50. And you say, okay, you know what? I'm willing to sell it if it gets to $20 over the next, let's say, 2 months. So you go out and you look in the options chain, you find a 2-month 20 strike call. That is the strike price at which you said you're willing to sell it. Let's say it's trading for 35 cents. So you could obviously just work a limit sell order in the marketplace. So if it gets to $20, you could just sell your stock straight out. That's very straightforward. It's very simple. It also doesn't reward you for any of the risk you're taking if you're working a limit order. Now, we've seen this in the market just in the last couple of years, right? Let's say GameStop. Let's say you were in it at 9 back at the beginning of last year, and then you were working a limit sell order to sell it, 20. And you got filled. You might say, woohoo, I did great, but then you missed out on a whole bunch of other upside. And sometimes you blew through those strikes within the same couple of minutes of each other. So there was demonstrable and continues to be demonstrable upside risk in the market. It's also the case to the downside, obviously, as well. So whenever you're working a limit order in a stock, you're taking some risk. You're missing out on upside profits, on losing money. So you should be compensated for that. That's why I think new traders should really use options to get compensated for that risk and to generate a bit of an income stream. Now, in this case, XYZ is trading $17.50. If it gets up to $20 and the options expire above $20, so in 2 months, the options expire, so the XYZ, I should say, closes above $20 at expiration, you now have sold that call for 35 cents. So you're effectively selling the stock at effectively $20.35. You got a little bit of a bonus for doing that there. On the flip side, if XYZ tends to hang out around 1750, maybe it drops a little bit, and in 2 months, it's kind of hanging out right around where it is, maybe a little bit lower. then you get to keep that 35 cents. And for every one lot you sell, that's on 100 shares of the stock. So that's $35. You sell 10 of them, that's $350 in your pocket. And guess what? Nothing else has changed. You've just now created an income stream from something that used to be a very passive thing you used to do without even thinking about it. People always work limit orders to buy and sell stocks. They don't think about A, the risk they're taking, and then B, the fact that they should be compensated for that. And people also spend a lot of time looking for high dividend yield stocks, right? They want to generate a lot of income from their portfolio. This is a way to do that without changing anything else. You could keep the stocks you like that you currently have in your portfolio and use something as basic as a covered call to generate that income stream. And it's a great starter trade for a lot of new options traders. And once they come around to the world of options and learn what a call is, what a put is, and they realize, wait a minute, if I sell that, I can generate an income stream, and it's doing things that I'm already comfortable doing in the stock. It's kind of like a light bulb goes off, and they say, wait a minute, this is so advanced. I never knew this exists. And really, it's just very basic, right? But when people start awakening to what they can do with options, it really is fun to see. You get that kind of light bulb moment. They say, wait a minute, this is cool. That's what happened to me when I first took a derivatives course in college. And I was like, wow, I could do this. I could make a stock if I want with these derivatives. I can make an option. I can make a bond. I can make whatever the hell I want with these things. These things are really cool. And so it kind of lured me to the dark side, and it sucked me out there to Chicago, and the rest is history. So people, when they have that moment, that aha moment, it's always kind of fun to see. And I usually tend to recommend them to try out the covered call as that first starter options trade.
Okay. So I guess I've personally never really traded options, hence why I chose this book, which is about options trading.
Yeah, let me ask you guys a question really quickly. There's a galaxy of options books out there. How did you land on Dynamic Hedging by Nassim Taleb? It's an interesting choice.
So what happened is, Jack, do you remember? I don't remember what episode it was, but we were doing Early Retirement Extreme by Jacob One Fixker, and he actually. We were about to do Black Swan, I think, coming up. And he suggested.
Yeah, that's the obvious Taleb book. That's the one everyone talks about. That's his brand.
Yeah.
Right. He suggested this book. And I mean, I enjoyed talking to Jacob. So I just figured and I liked all of Taleb's other books. So I figured I'd give this a go. But this was written in a much, much different style than his other books. Yeah. So I've never really traded options, but I guess I'm in my early 30s now, but when I guess I started investing, I was always told that options are very, very risky. Can you sort of maybe expand on that, and maybe why is that not necessarily true, or is it true? Or
yeah, that drives me crazy, that misperception that options are these inherently risk additive instruments, right? The second you add an option to your portfolio, bam, there it goes. Your risk just went off a cliff, right? That's insane to me. And, we've seen this now as more people are broadly embracing options. They're no more inherently risky than any other trading instrument you're going to have out there, right? It comes down to how you use them. Now, obviously, options have an inherent leverage factor to them. At least most of them do. Some of the new options they're listing now, in fact, just a couple of weeks ago, they listed a new nano option with no multiplier at all. So that one there's no leverage at all. So how risky is that? But in general, it's really how you use these things at the end of the day. And we tend to talk about them on the network here, that they really are suitable for a much wider array of audiences and users than the standard, disclaimatory thing that everyone has to have rammed down their throat by their broker and by FINRA and all the regulators. Once you take a step back from that stuff and realize these things are actually very useful tools, and you could use them in a variety, like, for example, the use case I just described, right? That covered call. Does that sound like a very risk additive portion of your portfolio? You're just doing what you normally would do with a stock anyway. You're buying and selling it. But in this case, you're getting a little bit of an income stream to do it. That's it. You haven't really materially changed your risk profile in any way. And so these are the things that people need to grasp. And it drives me crazy. I got into this business, like I said, I started in 97 is when I walked on the floor of the SIBO right out of college. And I kind of got lured to the dark side because in about 95, that's when the big Barings disaster was. Barings PLC, they had that. There's been movies and books about it. The rogue trader, Nick Leeson, he blew up Barings banks. The way most of these rogue traders do, they learn about options very basically, not much. And then they dump a bunch of puts. That's what always happens. And they blow up. And in this case, this guy blew up this storied London bank that had been around for a century or two. And it became a big headline making disaster. And once again, derivatives and the risk of derivatives were thrust into the spotlight. And I thought, I was studying finance at the time. I had been studying engineering. It didn't really excite me. And I thought, let me try something a little bit more practical use of mathematics. That's kind of how I got lured to the dark side of finance. And then here comes this Bearing scandal. And all of a sudden, everyone's terrified about derivatives. These are the riskiest things on the planet. And I thought, well, maybe it might behoove me to learn what these things are. Maybe it might be useful in an interview situation, something like that. I could drop some cool knowledge about derivatives and sound amazing. And so I started looking into these, and luckily, where I was when I went to school, they had some courses in the graduate school for derivatives. I was able to take one of those because I was a teaching assistant at the time, and that just opened my eyes. I said, wait a minute, I could construct all these things. In fact, on our Options Bootcamp show, we had someone ask us about books, and I went back and dug up my old textbook from that. I haven't looked at this thing in ages, and it's kind of fun to see a lot of the concepts we're talking about here in Taleb's book were in that book as well. And so yeah, people need to just, I think, first off, when they hear the options world, that's why we don't call it the derivatives insider or the derivatives, because the D word is just too loaded. People just hear that and they get terrified and they think, oh my God, you're going to blow out my portfolio. So we don't use the D word at all around here. And options still is also a bit of a loaded term, but people have started to come to grips to it more. But I think the key is obviously start very small, start very basic. Most major brokers these days, obviously very different from when I first got into the business, where these days, if you're a retail customer, you're almost deluged with options offerings. Now, it depends. It varies by broker. Some are better than others. Some of the Leviathans, like, the Schwab's, which owns TD and all these other platforms, they have this massive aggregated options platform that has many years of knowledge and education baked into it. So that's a good starting point. Others, Robinhood has been a sticking point for them for a while. They had a lot of new accounts they've approved for options for people who don't really understand it, and they don't really have a really great educational resource for those people to turn to. So it kind of depends where you're starting, but hopefully your broker has a pretty decent educational initiative. Luckily, there are places now you could go. Obviously, our network we have 2 shows that are aimed specifically at this. There are Options Bootcamp program, which I believe is how you guys discovered us, as well as our Options Playbook radio program. Those are both completely free. You can binge on them. There's hundreds of episodes each. You can listen to them at your leisure. Options Bootcamp actually goes back over a decade now, which is kind of crazy. People have been writing into us with questions about episode 1 that we recorded back in 2012. And I have to go back and look at it and say, wait a minute, oh my goodness, what were we talking about back in 2012 on this show? As you guys can imagine, I'm sure as your podcast gets going for a while, people are asking you questions about a show you did 10 years ago. It's a fun problem to have. But yeah, so that's, listening to shows like that, they're very basic, very introductory, very explanatory. There's a lot of great free options knowledge out there as well. Brian, who hosts that Options Playbook radio show for us, he also has a great optionsplaybook.com. It's free, completely just walks through all the plays of options, basic to advanced, completely free, just explains all this stuff to you. There's great resources out there like the Options Industry Council, OIC. Their website is optionseducation.org. That's an industry resource, effectively. The options industry has created that for traders to come and just learn about options. You can go there. There's a bunch of webinars. They have podcasts, everything, all free again, no agenda. They're not trying to sell you anything. They just want to explain options to you. And then, hopefully you combine that with your broker and they have some decent knowledge there as well and some knowledge base. Hopefully you can talk to people there who understand options a little bit. And then from there, once you get started, you start small. And again, other misperceptions that happen with options. You need a massive account to trade them. And there's 2 big misperceptions. One is that they're inherently risky, which I think we just talked about, that they're not. It all depends on how you use them. And then B, you need to have $50 million to trade options. That's not the case at all. You can do it with just a few $1,000s in your account. You start small, you do 1 lots. It depends on your use case, what you're trying to do, obviously, but you can utilize options, very small amounts. Also, most of these brokerage firms will allow you to paper trade options. That's a great way to start. So if you're listening to the shows we just talked about, maybe you're reading some of the OIC content, maybe you're reading some of the stuff your broker provides for you, and you say, okay, I think I'm ready to maybe try this, but I'm not quite sure. A lot of them will offer you great paper trading platforms too. So the covered call example I mentioned earlier, if you're still not really sure how that works in reality, you can go paper trade that and it'll mark it with real prices and you could see how that performs. So that's a great way to start if you're a little bit concerned about how these things work. And then start small, trade your 1 lot. Again, I recommend the covered call, but to each their own, whatever you decide is the trade for you. Don't get in over your head. Don't get over your skis too early. Don't start slinging 10 lots or doing crazy ratios or things like that. We recommend a lot of people like to use spreads early on as well, because it keeps your risk very mitigated. People get in trouble when they start, let's say, selling a lot of naked options, for example, and getting in over their heads where they don't really understand the true risk in these types of portfolios and these types of trades. So yeah, I say keys are start small, pick a broker, like a big major one that has a lot of great options wherewithal behind it. You could learn from them. Go to a lot of the other free resources that are available out there, like optionseducation.org, like our shows on our network out there. And then once you start putting all that together, you should have a decent understanding. And then we can talk about books in a minute too, if you want, because obviously there are a lot of options books out there we could sink our teeth into as well.
Yeah, absolutely. Why don't we touch on that right now? If maybe you could recommend a book for the beginner group, and then maybe one more for intermediate people.
Yeah. You know, it's funny. We just had this conversation on our Options Bootcamp show. Someone wrote in, a listener, and asked this question. And you know, what is your ideal book? And it's funny because for me, I know what my answer is. And whenever I talk to anybody who kind of came into the business the way I did, which as a market maker on the exchanges, all the professional guys, we all give the same answer. There's one book and one book only. It's like one book to rule them all. And it's a little intimidating for the beginners, which is why I hesitate to recommend it. But it is Sheldon Natenberg's Options, Volatility, and Pricing. That is kind of it. That is the Bible. That is the book. When I walked on the floor of the Chicago Board Options Exchange in '97, and when everybody else walked on the trading floor years later, there's one book they handed them, and they said, here, read this book, go home and study. You're going to learn how to become a real trader. And this was the path to actually committing real capital in the real world. It was this book. Now, I'm not going to go out there and say it's the most scintillating of reads. It's very dry. might be some good nighttime reading to put you to sleep. But if you can master the concepts as laid out in that book, that will set you along the path to becoming a great options trader. In fact, to this day, back when we did that Options Bootcamp segment, my co-host, Dan Passarelli, who's written some options books himself, he admitted the only book he still read outside of his own is Natenberg's. Most of the people who are professionals to this day in the space, that's the one book that everyone has read and utilized to kind of come to grips with options. So it's funny, I can recommend some of the other more basic ones, like for a lot of the newcomers to options. There's a reason why Macmillan is out there. The Options as a Strategic Investment, it's been around forever. It's had 1 million printings. People like that. I've actually only tangentially looked at that one myself, because that came around much later in the options world when I was already doing a lot of other things. But I had a lot of people recommend it. They say they like it. I've looked at it. I think it's a decent starter for a lot of people. And my co-host, Dan Passarelli, his book, Trading Options Greeks, another great one, kind of aimed for a very basic beginner options trader as well. So I think you could be well served with either of those. But if you're ready to take a bit more of a leap and really kind of dive into the options world, Shelley Natenberg, Options, Volatility, and Price. I still remember the green jacket. I have it looking around over here. Every trader has a copy. There's a reason why that's the Bible, and still is the Bible to this day. So I could tell you all these other ones. Dan even admits, I asked Dan, I said off the air, I said, okay, you know, which one do you recommend? I know you like your books. He's like, my books are cool. You got to go read Natenberg. So he's even plugging those above his own. So yeah, that is still kind of the Bible, which is funny because it's decades later, and it's kind of hard to find, like a lot of these good options books are, and it's not cheap. But it's certainly, if there is one book I recommend pretty much full stop, it is that book. And then once you have those concepts down, it introduces you to things like volatility skew and all these other things, the dynamics, the Greeks of the options pricing model. If you can come to grips with these things, you will be a much better prepared options trader, certainly than the legion of these ones who are, let's say, floating around Wall Street bets for a month or two and think they have it all down and they're ready to let the dice fly on whatever meme name they're betting on. You know, if you take your time and work through some of these books, then I think you will be well served out there, which it kind of does follow well, because the Natenberg book is an interesting comparison and juxtaposition to the books you guys wanted to talk about today, which is Mr. Taleb's. When I was looking it over again, Taleb's book, I was like, you know, there are a lot of similarities between these books, which are kind of interesting. But yeah, Taleb, I'm curious for you folks. You guys, I mean, you said you kind of have very basic options knowledge yourself. What did you think of the Taleb book? It's kind of an intimidating options primer, I think, for a lot of people.
Well, I'll say I got really into options after reading the Nigerian brothers Follow the Smart Money, and I had taken the actuarial exams, and we had some option pricing on some of those exams. So I Got it. I found the Taleb book a little dry. I gotta say, I wasn't able to read it all. So, I guess I'd be curious. Have you read the Nigerian Brothers book, Follow the Smart Money?
I have not. No, I haven't read their stuff. I know they've been floating around for a while. We do a lot of things with a lot of people on the network. I haven't had the Nigerians on, but we had a lot of other people out there. We do a lot in the unusual activity realm. So we do look at that kind of stuff a lot. We have weekly shows based on unusual activity. We always give a lot of caveats though about, hey, one of the major things we say on the network all the time is that, the size money is not always the smart money. Just because you see a 10,000 lot of calls going up in XYZ biotech doesn't mean that person knows something, doesn't mean that person is right. In fact, when you crunch the numbers, as we have on our network many times, more often than not, they are not right. The Activision kind of, Barry Diller kind of call scoop right before the trade, those are kind of fewer and farther between. There is a lot of informed paper going up in the options market. That is true. But you have to be a little bit diligent about exactly which ones you choose to find and which ones you choose to follow. And so there's a lot of work that goes into that, so which isn't always available to a lot of people out there, and isn't always mentioned in these books that are trying to, glamorize options, unusual activity as, this great source of wealth and riches. It takes a little bit more work than sometimes some people let on.
Okay, well, you mentioned, well, I guess you talked about the trades that you would make for a beginner. Like, maybe you want to go over some of the trades like that you as a seasoned vet like to make. What are some of your favorite like options plays that you do?
Sure, yeah, we can do that. I mean, that's funny. Everyone has the kind of their style that they develop and what they like to do. And what we trade now as kind of off the floor, retail traders is very different from what we used to trade, as market makers on the floor of the exchange. Is a very different style of trading. But yeah, these days, I would say now, ironically, we do so much content on the network and we're talking about options a lot. But I find it hard when I'm hosting a show or doing something to trade during it that often. So sometimes I have to put on things that I could manage a little bit easier because I can't stop a show and get off to go take off a trade whenever I want to. So I always tease our listeners, like, sometimes you're costing me money. But yeah, so with that in mind, I like to do things that I could kind of put on, maybe watch throughout the day and then take off, probably in the more short-term time horizon, but not crazy. I'm not doing like daily trades, probably usually in the weeklies. So if I see an underlying, for example, on one of our shows recently, we were talking about some of these options or some of these underlyings that were high flyers just a year or two ago, hot IPOs that have been extremely beaten up. Names like Robinhood, names like Oatly, and a few others that were trading, $30, $80, depending on the name, and now are trading fractions of that. Robinhood is threatening $10. Oatly is sub $5, sub $4, I believe now. So we're looking at some of those types of those underlyings, and if we liked them, we were using options to express bullish views. So a very basic way to do that would be to use near dated options, weeklies. In the case of, let's say, Robinhood, we sold about 1 month out options in Robinhood back when the stock was around $13 or so. We sold 1 month out put options, which is obviously the right for someone else to sell that stock anytime at $10. And we got paid 70 cents for those. So that was a pretty hefty amount. And so by doing that, we had identified the fact that we are comfortable buying Robinhood stock at $10. And so if it drops below there in a month from now, that option's expiration, we will buy that stock at $10 minus the 70 cents we collected. So $9.30 for a stock that was trading, I think, $89 not that long ago. So once you identify those types of levels, those types of trades are very straightforward. And again, that kind of goes back to what I was saying earlier about using options as an addendum to your stock trading. This is a way where we say, hey, we like this underlying, we won't mind buying it at this level. We will use options instead of working a limit buy order for Robinhood at $10. That pays me nothing. If the stock drops down there, I get filled. But if the stock rallies away from this, which it looked like for a while Robinhood was going to do, if the stock now turns around and rallies away from the $10 strike, I will keep that 70 cents that I sold to on this put option, and I'm free to do it again a month after that or the week after that, whatever the case may be. So it's a very repeatable kind of rinse and repeat type trades. That's a very basic one. We like talking about those. We get a little bit more advanced sometimes with ratio spreads, ratio put spreads in particular, where we like an underlying. We were trying to do this in Robinhood, where you buy a put that's slightly out of the money, let's say when Robinhood was trading around $14, I think I bought the 13 put that expired in about 2 weeks. And then I sold 2 of the $12 put, so a little bit farther out of the money. And you can tell by doing that, if you understand your options, you buy 1 and sell 2. That means when you break through that 12 strike, you're going to effectively be on the hook for the stock at that price. And usually when you do those, you like to get a credit for that. The 2 options you sell should offset the price of the 1 that you buy. And but in that case, it was hard to get credits in Robinhood. But that's another type of strategy we like to set up, buying 1, selling 2. That also leads to that type of ratio spread, also popular with butterflies, which is effectively buying 1 option, selling 2 farther out of the money options, and then buying 1 more option farther out of the money against that in case the worst comes to pass. So those are great types of trades. If you like an underlying, you expect a reasonable amount of movement in a reasonable amount of time. And but you don't want to maybe spend all the money up front to buy. Maybe the option is a little bit expensive. Maybe the volatility is high. A good example of a name people do this in a lot is something like UVXY, which is kind of one of these levered VIX products out there, which moves around a lot, but the options can be very expensive. Sometimes if you don't want to just buy a put because it's going to cost you an expensive outlay, but if you sell 2 more options to offset that, and then you buy a farther out of the money option against that to mitigate your risk, now you have a very set package. You know at the outset how much you're risking, you know how much you can make and how much you can lose on that trade. So it's a very kind of, I won't say set it and forget it, because you have to keep an eye on it and you have to adjust it at times, but it's a very manageable type trade for people to approach because it's all one package. And that's nice, as opposed to, we don't recommend a lot of trades that are just naked risk. We don't recommend you get what we call naked short units, which is an old market making term where you're just short a lot of whatever it might be. And if you blow through those strikes, you're just incurring a lot of risk. And everyone who knows anything about basic stocks knows if you short a stock, you have infinite risk to the upside. Well, it's the same thing if you are a net short units in an option. It could be the downside, it could be to the upside. Once you start blowing through those strikes, you start accruing a lot of risk. We always recommend spreads. So those are a few interesting ways. Another type of strategy I like, and I think is interesting for some newcomers to the market, is what's called, again, these names, I didn't come up with these names. Don't blame me for these names. They're very intimidating. Bullish risk reversal. So this is the case where you look at an underlying, and we talked before about selling a put on that underlying. So let's say XYZ is trading $20. You think, well, you know, if it drops to $15, let's say in the next month, I might buy it there. So you see the 15 put is trading, let's say 25 cents again. So you sell that put. So now anytime in the next month, if that option expires, you know, if that option expires at the end of that month below $15, you will buy the stock for effectively $14.75 because you collected 25 cents. But now you sold that put for 25 cents, you're sitting on a little bit of a credit. You might want to put that credit to work. You might say, well, maybe I think the stock may actually rally in this time. So I might turn around and buy an out of the money call with that credit. Let's say in our example, let's say there's no skew, everything's even. So the 25 call is also trading for 25 cents. You say, I'm going to sell the 25 put for 25 cents and use that money to buy the 25 call, or say 15 put and the 25 call, and use that 25 cents. So now you're flat, you've collected no money. And you obviously have that risk. If you blow through the 15 strike, you will be buying the stock at $15. But now you also have an upside position. So if the stock does take off, then you now have effectively a bullish, a long delta position in this underlying. It's going to depend obviously on the deltas of the calls that you sold, the call that you bought and the put that you sold. But it's going to be some approximation of a bullish delta. So as the underlying rallies, you get to participate. And if it blows through that 25 strike, you get to participate in that. And so it's a good way to get exposure to a stock that maybe you don't want to buy the stock outright, but you want to maybe do a little bit, so have a little bit of a cheaper, lower cost way to get a bite at the apple there. Now, of course, there's risk. You're going to tie up capital because if the stock drops below 15, you've guaranteed it. You're going to buy it there. So the broker is going to tie up some capital to buy up the stock at $15. But so just bear that in mind. There's no free lunch. There will be some opportunity cost to this trade. But that's another great way. If you're looking at a stock and you're thinking, maybe I don't want to straight up buy it. I don't want to just buy a call. I want to offset that outlay a little bit, because let's say you do that trade and then nothing happens. Your outlook doesn't come to pass. The stock doesn't rally. Then it didn't cost you anything outside of the opportunity cost. You didn't buy that call and lose that money. You didn't buy the stock and sit on that. You just ended up doing that trade. And so it ended up working out and nothing really hurt you. So it's a great kind of lower cost way to take a bite at the apple. So there's a lot of those types of trades that so if I had to break it down to a handful, I would say I like bullish risk reversals. Those are great. I like, butterflies are great. And then short puts and put spreads as a way to get into an underlying. And again, going back to those basic trades we were talking about before, you can combine these things in great fun ways that are still very basic, still very easy to understand, and very effective. Like we were talking about Robinhood before. I sold that put for 70 cents. Let's say a month from now, the stock is trading at $9.50. So it's through my 10 strike where I sold the put. I'm buying the stock now. I'm on the hook to buy the stock for $10 minus the 70 cents I collected. So my effective price is $9.30. So I'm still looking pretty good on that trade. Maybe in that month, maybe some news has come out. Maybe I decide, you know what, Robinhood's garbage. I don't want to own this thing anymore. So I could sell the stock, obviously, or I could do what's called the wheel trade, which is effectively a way to get paid to get into the stock, like I did by selling that put, and then turn around, and now you have this stock position, and you sell a covered call now against it. So in this case, maybe it's hovering around $9.50. Maybe I'll sell that 10 call again to the outside. So I'll sell that same strike. And maybe in this case, I'll get, let's say, I don't know, 35 cents. And so if the stock sits there, I've sold it for 70 cents. I've collected there. I collected 35 cents. I can keep collecting on this position. If the stock rallies, I got paid to get into it and I got paid to get out. It's called wheeling. You wheel into the trade and you wheel right back out again. And so that's another way you can combine these very basic strategies. Again, this goes back to that misperception. Options are super complicated. They're very risky. They don't have to be. You can do them in a very straightforward, very risk-defined method, and it's very additive to your trading at the end of the day. So once you overcome these hurdles, these misperceptions, and you start to take these basic first steps, you'll realize these are actually very useful tools for your trading, and they're not these scary monsters that everyone's made them out to be.
Awesome.
A long answer to a short question. I apologize.
So I think that's, yeah, you have any more questions?
Yeah, sorry. Could you go over the wheel? I don't know if I totally understood. Can you go over the wheel trade again?
Sure, we can do that. Yeah, so wheel trade. Let's go back to that real world trade I made. I sold a 1 month put in Robinhood, the 10 strike put. I collected 70 cents for that. So in that case, if Robinhood closes and the option expires a month from now and the stock is below $10, no matter where it is, below $10, I will now own Robinhood for the effective price of $9.30 because I sold that strike, the 10 strike, and I collected 70 cents to do it. So that's the beginning of the trade. I have Robinhood stock now for $9.30. Let's say it's hanging out right around there. Maybe it's trading $9.50 in our example. And I decide, you know, maybe I don't want to keep this stock anymore. I could turn around and sell. I could talk about selling the covered call earlier, where you look at a stock, you decide a level that you want to sell it at. And rather than just working a limit order on it, you turn around and sell a call at that strike. So now you're getting paid to sell the stock. So in this case, in this example, in the wheel trade, the goal is to get paid to get into the stock and then to get paid to get out of it again. And so in this example, I could turn around and sell, let's say the 10 call, maybe I go out a month again. And maybe in this case, it's still volatile. Maybe I get 50 cents for it. So I collected 70 cents to get in. If the stock rallies back to 10, I'm out again. So I kind of scratched the stock. I did nothing. And I collected $1.20 worth of premium. So if I did that 10 times, that's $1,200 on a $10 stock. That's over 10%. That's not a bad return. So that's the basics of the wheel trade. Selling a put on an underlying at a price you're okay buying it at, but then maybe something happens, or maybe you just don't want to keep it for that long. You want to churn it a bit. You turn around, you sell a covered call against it. You probably want to be a little bit aggressive with the covered call because the goal is to kind of get out of the stock. So you could sell an at the money strike or maybe slightly out of the money, maybe a little bit in the money if you want to be really aggressive. And then you're kind of guaranteeing that your stock will get called away. And then that trade is done. You can rinse and repeat and do it again. You can do the same underlying, you do other ones. There's a lot of very adaptive type strategies. That's why they call them options. You could do a lot of different things with them. So yeah, that's kind of the basics of the wheel trade there. And so yeah, you guys were, sounds like you guys were a little overcome by the Taleb book. It's an interesting book. It's funny when you guys mentioned you wanted to talk about it. I was like, I have it. I read it ages ago, and I have it in our studio. We have a lot of books in our studio, and they kind of come and go because we give away a lot to our members, to our pro members. We give them all kinds of stuff, and we have giveaways and giveaways all the time. So they get to pick what books they want. So I went looking for the book, and I said, oh, I can't find it. We must have given it away to one of our members over the years. So I went looking online to see if I could get a copy just to refresh myself with this, and I realized even the Kindle version these days is $78. just for the crappy Kindle, which everyone says is terrible. Don't get it because it has none of the graphs and things. So yeah, if you want to get this this Dynamic Hedging by Taleb, yeah, maybe hold off a bit. Luckily for you, I found this. There are many free versions out. This book's been around long enough. I think people can they can find it as I think free find a bunch of places. Type it into your browser, listeners. You will find extremely long 500-page PDFs, but they are out there. So you can scroll through this, which is probably the way, if you are going to read this book, I recommend you do it, because $78 just for a digital version of this book is absolutely insane. And also, I think the caveat for this book too is it came out, like I said, in 1997. The markets have changed quite a bit since then. Just some basic framework for when this book came out. That the markets were still they're not electronic at all. There were no electronic exchanges. It was all pit based. They were traded in fractions, 16ths and eighths. There was no decimal pricing even. Options, they were singly listed. So one exchange, like the CBOE, the one I was on, dominated pretty much the entire options market. Then other exchanges came along. Now there are 17. So it's changed. This book is so old. He gives Victor Niederhofer a blurb on his cover. He blew out that same year. He blew out in 1997 selling puts in the SPX. So I don't think anyone would have them on their cover anymore. So yeah, this just shows you this book is a bit of an antique when it comes to that. And there's some interesting concepts. A lot of this is around market making, which is what I used to do. So I kind of wish that maybe I had read this book earlier. That would have been nice if I had read it early. Maybe they had handed me this book alongside the Natenberg book. That would have been a good combo, because this talks about some of the utility and things you need to do as a market maker, which would have been informative to me back then. I don't know how informative it is now for a new options trader out there, and the notion of dynamic hedging. That's what we used to do all day long, day in, day out. It's called gamma scalping, effectively. It's a very intricate concept. That's kind of what the book is about. Again, for a lot of retail, it's not a very retail friendly type of trade because it's very capital intensive. It involves having an option position, and then the underlying moves in a certain direction, and then you sell stock typically against it to hedge it, and then it drops back down. You try to buy that stock at a lower level. It's very capital intensive. You have to buy and sell shares of stock all day. And for most retail accounts, they can't afford to do that. So I don't know if this is might be a little bit much for the average retail folks to pick up out there. And also Taleb, he's an interesting character. Let's just put it that. It comes across in some of the writing. Let's just say he's a fan of himself. I think we'll put it that to put it mild. He's a fan of his own work. It comes across in a lot of. I pulled the blurb, which I thought was funny here. Where is it? Oh yeah, here. So this is just in the preface to the book. He's just started, and he writes, "I clambered." First off, clamber. It's not a word people use very often. He clambered up to my attic, where during 6 entire months, I spent 14 hours a day, 7 days a week, immersed in probability theory, numerical analysis, and mathematical statistics. And he puts in parentheses, at a PhD level. Then I began to write this book. So he had to put that aside in. He just had to put that in. That after he clambered to his attic and he worked so diligently for months and years for your benefit, it was all at a PhD level. So there's a lot of that mixed in there as well, listeners, which over the years, a lot of people it's been off-putting for a lot of people to Taleb stuff. And then of course, he's become known now as this, this black swan guy. He's created this brand, which has exceeded him in every way, shape, and form. There are black swan conferences and black swan funds and black swan t-shirts and you name it, black swan, everything. It's a crazy concept. And it's funny because I think it was about 4 or 5 years ago on our volatility show, we had some guests on. We happened to be talking about Taleb and the whole black swan phenomenon. And, when you hear that black swan and when you hear this notion of the black swan is effectively, this unknown event that's going to wipe out the markets, right? When you hear that and someone's preaching that all the time, if you had to guess what type of options trading strategy this guy employs, what is he doing? If you had to guess, what would you think it would be?
Out of the money options.
Yeah, you're right. He's buying out of the money puts. You're right. Because he's hedging, right? He's hedging against this otherworldly calamitous event, right? That's what everyone assumed. And then we were talking to some other portfolio managers and well-known writers about options, and we kind of started digging into it. We realized actually he doesn't do that at all in the real world. He sells puts, and he sells puts, out of the money puts, and then he buys farther out of the money puts against them on a ratio. So it's kind of like what I was talking about before with those ratios. Instead of buying one and selling two, he's selling one and buying 2. So there's a lot of risk if it drops, the market drops, but not a ton, because then it's dropping to that strike he's selling. And meanwhile, the ton of options that he's buying on a ratio haven't kicked in yet. So it's a much more advanced, and if someone just hears this black swan, they have a very surface exposure to it, they might think, I have to buy all these puts because that's what this black swan guy tells me to do. I have to hedge against this black swan. And that's actually a very expensive thing to do. And over the long run, it's ruinous to your portfolio. Heck, the guy who wrote Black Swan doesn't even do it. So it's just something, that's one of the issues I've had with Taleb's stuff, is that the perception, maybe it has outpaced his works. I mean, I'm sure if you spend a lot of time reading all of his works, you might get that perception a little bit clearer. And I think the surface perception for a lot of people is these black swans are out there, they're coming, I need to hedge my portfolio against that. And if you just go do that and you buy your standard out of the money option and let's say SPY, that's extremely expensive. That's going to cost you the minimum we see on studies for doing that every couple of months. Let's say a 5% out of the money SPY option, it's going to be at least 8% a year, which if you know anything about indexes, the average return is around 7. So that you're already in the hole there. And then it's probably going to cost you a lot more if the puts get expensive, like they kind of are getting right now, as we're selling off in the markets. So you're talking maybe 15, maybe 20% just costing you every year to hedge this thing. So that's the issue I have with some of this stuff. People can hear about this black swan and they get all bent out of shape about hedging these risks they don't understand in ways they don't understand how to do it. So yeah, I just caution you, be careful with these types of books. And don't just rush out and buy puts because you read some of these books. Take your time, do your due diligence, look at put spreads. Those are great ways to offset your trading outlays as well. And that strategy of selling 1 and buying 2 on the downside can work. It's a little bit more advanced and something that I think only pros really should be looking. I'm just looking at some other interesting nuggets from his book. He slams all the folks at Long-Term Capital Management, which was a hot thing when he wrote this book back in '97. That's when Myron Scholes and all these options wizards, the market wizard guys effectively came in. All these Nobel laureates created this firm called Long-Term Capital Management, which didn't last very long term at all. They all blew out right away. He mentions, he kind of slams those guys in his intro as well here. So yeah, he's throwing shade himself here, Mr. Taleb. And he mentions some interesting concepts too, which are kind of fun, I think, for traders in general. He says holding a trading position requires such an intellectual commitment that the trader may feel consumed to the point that other functions of the mind slow down. Its comparison is the RAM of a personal computer that is heavily burdened by a program running in the background. I actually had that on my time on the floor as well. When I finally left the exchange for a while, I felt completely burned out because it is a very draining thing over time. And it does, if you're not careful, the trading mindset and mentality can overcome a lot of what you do to the detriment of other aspects of your life. So that is a point that I think is worth noting. He mentions things like tacit rules in market making, which again would have been cool for me in the 90s when I was making market. I'm not sure for a new trader now, if that might be a little bit intimidating. He talks about things like locals and paper, all these terms we used to throw around on the trading floor that aren't really viable for a lot of people out there. The feeling he got being an upstairs trader versus being a pitch trader. So all these kind of interesting nuances. If that intrigues you, then this book is out there and it is available, for free on a lot of places. I would not pay the $78 for the Kindle version. Oh, he makes another good point too about liquidity. That's probably a good one to bring up because this is applicable to a lot of traders out there. He says it cannot be stressed enough that liquidity is the most serious risk management problem. A substantial part of unforeseen losses is due either to market jumps caused by illiquidity or to liquidation costs that substantially move the markets against one's position. Liquidation costs tend to be usually underestimated since operators usually fade when someone is forced into a market action. That's another trading term, fading. But that's a good point. When things get illiquid and markets are crazy, like at the end of the day last week when things were selling off or over 2%, things are getting a little crazy, things are getting a little wide. Those are times when people don't underestimate how liquidity can vanish, even in these big liquid options markets. And so that's something to be aware of. We were talking before about the benefit of buying a put versus just using a limit stop order in the stock. Those are the kind of markets where having a put in your back pocket isn't the worst thing because you can count on that. You are stopped out on that strike no matter what else happens. Whereas the stock, if it's just gapping down all the time, that limit order may not be that useful for you out there. So he mentions actually some of the risks of stop orders and in a liquid market. So those are things that I think even a basic retail trader should be aware of. The dynamic nuances of hedging a market making book, maybe not. but that stuff, being aware of liquidity, maybe some of the taxing that trading can take on your brain and on your lifestyle if you let it run away with you. Like I used to say, some of the best guys I knew on the trading floor were the best traders. They were myopically focused on trading to the point where it degraded other parts of their lives. They really, you couldn't talk to them about much else. They weren't conversant in much else. They were top of the game when it came to trading and making markets and risk management, understanding all that. But it almost required that level of obsessive devotion and commitment to really make things work in that. So that's something, for the average retail trader, these are good things to do and to trade, and it certainly has a meaningful impact on your life in terms of your income. People maybe want to become professional traders or professional at-home retail traders, which a lot of people are doing now. That's certainly great, but you also have to be able to turn it off and go hang out with your family, or whatever the case may be, or be conversant or knowledgeable about other topics besides markets and bid-ask spreads and volatility and all those things. So that could be a challenge sometimes. But so there are some interesting nuggets and pearls of wisdom to be mined. I don't know if it's worth. Did you guys finish? One of you said did you both not finish the book?
It was the first book, I have to say, I've tried to read in a very long time, where I really did not understand what he was even trying to say.
Yeah.
So I was also not able to get through all of it.
Yeah, it's a challenging one. I wish he had reached out to us first. I would have recommended maybe some other more user-friendly starter material for you as opposed to leave. You have to go back to your guest who recommended this one and say, maybe you need a different recommendation for this starter options book. Hopefully it didn't put you off options trading for the rest of your days.
Oh,
well, I hadn't really started, so yeah.
Well, there you go. You're in good company. We did a poll of our audience not too long ago, a few months ago, and usually when we do that and say, when did you start trading options? We have a lot of people who've been trading for a long time, very experienced, a lot of professionals in the industry who listen to our stuff. And there's obviously a lot of the bleeding edge retail folks out there as well. But just in the last year or two, we've seen that number just explode to the point when we did that poll a few months ago, I think it was 30% of the audience had started trading options in the last 3 months.
Wow.
It was insane. And that's just kind of the norm now. So many people are discovering these things and they're coming to them through online forums or wherever they're finding it these days, and social media. And they're saying these option things are cool, and they're diving in, and there's next thing you know, they're trading options probably before they really are ready. They're getting approved at an outlet like Robinhood, which automates all that stuff, makes it very easy to game the system to get approved. And they're diving into and usually buying calls, which is, again, not my favorite trade because it's a low probability trade often. And it can give people a bad taste for the options market for their first trade. They buy a call and it doesn't work out, and then they don't want to trade options again. So something like a covered call, again, a little bit higher probability trade, makes a little bit more sense for your portfolio. It's a better starting point because it's easy to understand and it's a higher probability trade. You won't leave as dissatisfied, I don't think, as you do if you're just buying a bunch of out of money calls and hoping for the best. Then you're just pretty much going down to the corner store and buying the scratch off lottery tickets, right? Maybe it works, and in GameStop and in AMC it worked for a while until it didn't. But you can't make that your long-term strategy. That's not a road to long-term success in the world of options, just scratching off the cards.
Well, Mark, I've loved hearing your perspective on this book, and I'll say that I loved your Options Bootcamp podcast. And why don't you tell our audience where they can go find more of you? Sure.
The easiest place to find all of our content is just theoptionsinsider.com. Don't forget the at the front of the URL. It has all of our shows, all of our content, everything. If you want to go to all your favorite podcast outlets, we're available just about every place under the sun. If you want to get all of our shows, you have about a dozen. Then just, again, search for Options Insider or Options Insider Radio Network. If you want to find all of our shows will come up. If you want to get specifically to the educational stuff we were talking about, Options Bootcamp remains one of our most popular shows. Everybody loves it, and especially, as I mentioned, with 30% of the audience coming in the last few months, they all are just mainlining education as fast as they can get it. So Options Bootcamp is a great resource. We've been doing it for a long time. I do it with myself and another actual options author. I mentioned him earlier, Dan Passarelli, who wrote Trading Options Greeks. It's another good starting book out there. Also, Options Playbook Radio, another good educational resource we have on our network. And again, we're not looking to sell you anything. We just want you to come learn about options at your leisure on your own schedule, and hopefully you'll become a better trader and you'll hang out in the options market for a long time and you listen to a lot of our content and have a great time.
Yeah, you want to take us out?
Yeah, Mark, thanks for coming. I think it's been a great episode. It's been really fun listening to you talk, but please reach out to us at brothersonbooks@gmail.com for any book recommendations, or if you would like to be a guest host for a particular book you have in mind. A great review or rating on whichever platform you're listening to would be greatly appreciated. And lastly, if you can think of any friend, family member, or coworker that might like this episode, please pass it along. I'm Alex Allweil, and with me as always is my co-host Jack Allweil. And Jack, what episode are we doing next, or what book are we doing next?
Well, we're going to take a little bit of a break, and in 2 weeks we'll be doing our goal edition, where we'll be discussing how we're implementing what we've been reading into our everyday lives, options and all.
I think I'm excited for it. I think it should be a fun episode.
Yeah. So Mark, take it easy. Thanks so much.
Thank you. This was great.